Welcome back to the show, Sports 634. Michael Leibowitz, CFA, joining me in studio live from his normal office in Maryland, where it snows and all that kind of stuff.
All kinds of good stuff.
But you have a beach close by. Your beach is actually better than our beach, right? So we have a beach that's about an hour.
So you've never been to Ocean City, Maryland?
No. Well, yeah, you haven't been to Galveston, Texas.
Right.
So, Brent, give Mike a quick descripto.
Ocean City wins. Galveston's like that little cake on the edge of your toilet bowl.
Kind of that idea.
and the currents in the Gulf are the swirling of the water in the toilet bowl.
So the water at Ocean City, Maryland may be a little nicer, but everything else ain't.
So, yeah. We'll see.
Right.
Well, I'll take you to Galveston next time you're down for the summer.
And you'll come out to Ocean City.
Yeah, I'll come out to Ocean City.
I'll drop you off, and then I'll go up to Delaware, and I'll come pick you up a week later.
Thanks. Appreciate it.
Each of you bring back a sample of water. We'll put it on the camera.
Exactly.
Compare.
All right, so Federal Reserve. A couple of things that we've talked about here lately is that, of course, the Federal Reserve, and we've talked about this whole issue with repo, which has been kind of forming some type of bailout for somebody somewhere. And we don't know who it is. The records have been sealed, but we know that there's something that's not quite right going on with all this, and that the Fed is actually monetizing debt. The Federal Reserve has been buying bonds that have been issued 3 days prior. So as soon as the Treasury issues a bond to raise capital to pay for our deficit spending, which we're now running in excess of $1 trillion a year, the Federal Reserve is then buying those bonds through other banks. So a bank has to buy it, and then the Federal Reserve buys it from the bank, and then that money flows into the system.
Buying it with printed money. You left out a crucial part.
Sure. Yes, the printing presses are running full bore,
right.
By the way. But here's the interesting aspect of this, and we actually have an article about this today on our website. So if you go to realinvestmentadvice.com, there is a belief right now, because look, markets are all-time highs. Absolutely. I mean, the markets are going to open today. We're going to be at our target. We set a target last July of 3,300 for the S&P 500. We're hitting that today, and that target was for all of 2020. So
We're done for the year.
We're done for the year. Hit our target.
Let's go home. Come back in January.
So we'll have to boost our target to 3,500 now.
Well, that's what Wall Street does.
Yeah, I know, right? Just keep pushing it up. But the interesting thing is that while Wall Street believes that the Fed has actually got everything under control, right? The Fed's not going to allow anything to happen, not going to allow anything to happen to the economy. We saw that in December of 2018, right? So the Federal Reserve had come in and in September. And we had all kind of had high hopes for Jerome Powell. He was not a markets guy. He was a true kind of Fed practitioner, and that he would come in and do exactly what he did, which was start to reduce the balance sheet, start to remove QE, start to raise interest rates a bit, and kind of prepare the Federal Reserve for the next recession whenever it would come. Well, as soon as we had a little bit of a hiccup, everything reversed, right? And so he learned very quickly that he has to be a markets guy.
And by markets guy, I think what you're alluding to is that he has to support markets at all times?
Yes.
Okay.
Pretty much.
Just making sure.
Like Ben Bernanke.
Right.
Ben Bernanke's third mandate was, oh, yes, we target asset prices.
You mean his first mandate?
Exactly. But so the premise of the article today is that everybody has this belief that the Federal Reserve now has everything under control. We can't have a recession. We can't have a market crash. Take on all the risk you want in the markets, whether it's junk bonds or stocks that have no earnings value, whatever it is. But the reality is that the real problem potentially becomes when a issue occurs, some exogenous event occurs, that starts a cascade event across multiple areas of the markets. This is not 2000, and this is not 2007. In 2000, baby boomers were not 65 years of age and retiring. In 2007, baby boomers were not 65 years of age and retiring. Boomers are retiring at a rate of 10,000 people a day. Their pensions are on the line, and there's a $7 trillion funding gap for pensions. So if you blow a hole in the market, you're then going to create a cascade event of credit market issues, pension issues, and a whole variety of other market-related events that the Federal Reserve simply cannot afford or has the ability to bail out because they can only buy debt issuance. So this is the gist of the article today, and it's on our website now. why the Fed might cause the next crisis, not actually prevent it. But Mike, to you, one thing that's really been talked about lately is the fact that this really isn't QE. All the Fed is doing is buying very short-term bills, and those expire within 30 days, and then they've got to buy them again. They're just providing short-term liquidity. But from the market standpoint, if it looks like a duck and walks like a duck, it's probably a duck. But that's all changing, though, in the next few months, and the Fed is going to make a change.
Well, it's QE. With all of QE, even if they go and buy 5-year Treasury notes, when that 5 years comes up, those things mature and they go buy new ones. So whether they're rolling every 5 years or every 1 month or every 3 months, it doesn't matter. Operationally, you're doing the same exact thing. And it's having the same exact effect on the market, because if they were just doing 1 and 3 month Treasury purchases and they would mature and that would be it, that's different. I would agree. That's a one-time operation. But they're already rolling stuff over, and they have no intention of letting the size of their balance sheet drop. This is going to go on. And I think what ultimately, like you just alluded to, what ultimately happens is that they get, it's just a lot. All these 1 and 3 month bills constantly coming up. It's a lot to keep rolling them over. And I think they just say, okay, we'll just buy a 5-year or 10-year and avoid having to do so much transacting on an almost daily basis.
Yeah, and I think what we'll see over the next few months and into the end of this year is that we'll see that actually occur. So we'll start to move from 1 month bills to maybe 3 month bills to 1 year bills, and they'll just start extending out the duration, and then gradually that'll just kind of meld into the balance sheet of 10-year treasuries at some point.
This is all, I use that hashtag Fed gibberish because they try to say things in different ways so you think it's something different.
Right.
I was actually talking to a good friend of ours, Jack Scott, and I said, think about the word quantitative easing, QE. Right. What is it? Easing, we all know what easing is in economics. That means they're lowering rates to stimulate the economy. Quantitative is just to count something. So they're buying bonds. Why is that just not easing? Because it's because they have to make it more confusing.
Quantitative easing, it sounds very
sounds like they know what they're doing.
Exactly. I mean, qualitative easing, that doesn't really play in very well, right? And easing is just too short.
And easy easing would
and they can't be honestly true about it. Just say, hey, no, we're just juicing the market.
Right.
So just call it what it is.
Right. Market support 101.
Yeah, steroids. Kind of like Barry Bonds.
There you go. Yeah, but.
Yeah, but Michael wrote this really great piece yesterday about Barry Bonds and the relation to the markets called Yeah, But. And it's actually on the website now. It's a really great read because, Barry Bonds was one of the greatest hitters in the history of baseball.
Right, yeah. Barry Bonds was a great player. And if you look at his stats, especially after he took steroids, he may have been one of the greatest ever. And this is in his mid-late 30s. But there were steroids, and he'll pay for that.
Yeah, Lance Armstrong, 7-time winner of the Tour de France.
Right.
You have to say it with the France.
The France.
Yes, you have to de France. Exactly. But he was the 7-time winner. Yeah, but
right.
It cost him more than I think it cost him more than he wanted to.
I don't know what we're allowed to say on the radio.
Exactly. Not that one. Yeah.
So that's the problem, though, is that they're using stimulus and they're getting the desired effects. The market's going up, but there's no real benefit to the market, to the economy. You're just pushing stock prices beyond what makes sense based on earnings, based on profits.
Well, and that's kind of really the big concern here is that when you take a look at price to earnings growth, it's at an all-time high record. Take price to sales. That's at we're at the highest level in terms of that ratio, price to sales. So in other words, investors are just way, way, way overpaying for what they're getting. But it's the hope that all of a sudden the Fed Reserve can engineer this soft landing, and we're about to have this explosion of economic growth coming. The question is, where's it going to come from?
Yeah.
Right. What's going to drive that economic growth? Because if you take a look at kind of everywhere in the world, whether it's not just the U.S., but it's Europe, it's China, the debt input has reached massive levels of where they're simply getting to the point where you just can't keep leveraging up the debt at a rate fast enough to keep the organic economic growth going.
Of both the market and the economy.
Exactly. So, quick break. We'll be back. More with Michael Leibowitz. Wrap up the show this morning. Don't go away. You're listening to The Real Investment Show. Get by the website. Both those articles on the website now. Yeah, but talking about Barry bonds. And, of course, the Fed, they won't necessarily avert the next crisis. They may very well cause it. It's on the website now, realinvestmentadvice.com. We'll be right back.
Broken-looking glass. 7 years so bad now.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.